Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. This is Daniel Lam, your host for the podcast. Now, in the podcast this Monday, we talked about how we could be primed for short covering in equities. There, we talked about the divergence between the index charts and key indicators such as the RSI, which has been showing diminishing strength in the selling. We did note that we do need to have macro data as catalyst, and Lord and behold, we have been getting the bad news is good mantra coming back to us over the last 48 hours. First of all, the US manufacturing data has been soft on Monday, with ISM manufacturing prints at 50.9 versus the expected level at 52. And then overnight, the US job openings fell the most in nearly 2.5 years, suggesting that the labor market may start to be cooling off finally. This is prompting investors to believe that the Fed may need to reassess their current hawkish stance, because the effect of the previous rate hikes may start to be feeding into the economy. And the result? The biggest two-day gains in US equities since 2020. No doubt, there are a few questions in your mind right now. So for example, for those of you who have not been trimming down on equities, but are looking to do so, shall they be taking advantage of this rebound and trimming equities from here? Or, for the more aggressive investors, should they be chasing the gains from here? Well, the market has been heavily sold off, so the positioning has been very light by the end of last month. The path of the least resistance, at least for the very short term, seems to be up. And in the podcast on Monday, I did highlight 3,900 for S&P 500 as a key level of resistance. So those of you who want to offload at a better level, they may consider doing it around 3,900. Another way worth considering is to rotate their equity exposure into high dividend equities, as we've been highlighting in these podcasts. Now, what about for those of you who are more aggressively inclined, i.e., those who want to actively trade these markets and chase the upward rebound? Well, they would be well advised to do so in a controlled manner, both in size and also in profit and stop loss levels. For example, they may consider going in now and use 3,900 as a first level to take partial profit, and then 4,100 as the next level for profit taking. On stop loss level, 3,500 seems to be a reasonable level to take. How successful will these short-term trades be will depend highly upon the next two pieces of data. This Friday, of course, the critical piece of data is the non-farm payroll. If we do get any weakness on wages and the unemployment figures, this may lead to speculation that the Fed may need to reconsider powering back on its pace of rate hikes. And of course, we will get more ideas from the US CPI figure the coming Tuesday. That's all from me today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.